Hello, and welcome to Investor Analytics. We're in the business of helping professionals make better risk decisions. In this short video, we're going to talk about two topics: the Altegris CTA Challenge and what does risk really mean to an institutional investor. Altegris teamed up with Investor Analytics to help them conduct their CTA Challenge. Every day throughout the year 2013, 27 different commodity trading advisors are being evaluated using Investor Analytics and Altegris systems on both risk and return-related measures. At the end of each month, the leaderboard is updated, showing the top 5 contestants as of that point in time. By the end of 2013, 5 finalists will be chosen, and ultimately one of those will be declared the winner. Those contestants are being evaluated on these 6 different scoring analytics: daily return versus daily vol, downside vol, max drawdown, margin to equity, VAR, and daily conditional VAR. It's no coincidence that every one of those involves risk. Other institutional investors are also increasingly looking at risk investing in CTAs. They're not just looking at drawdown, but they're also looking at how the CTA actually applies breaks in managing that drawdown. Understanding that trend following and compounded drawdown returns are part of investing in CTAs. Institutional investors want to understand the process that CTAs go through in managing that particular risk. Starting with a particular level of AUM, institutional investors don't just want to see that historically the drawdown has been low, but rather what process does the CTA go through in managing drawdown loss. For example, several stop losses on the way to ultimately getting out of a given position. Importantly, CTAs need to understand that the institutional investor views your portfolio as a part of their portfolio. They evaluate potential investments based on your contributions to their returns, your contributions to their risk, and VAR over time. Last year, Investor Analytics published a white paper on risk aggregation, including our survival guide for institutional investors and how they should think about risk of the individual managers that they invest in. Finally, it's also important to note that institutional investors, particularly pension funds, have historically thought about risk in very particular ways, and those usually are relative measures of risk, things like tracking error and beta, both of which measure risk relative to a particular benchmark. Neither of those concepts is particularly familiar to CTAs, and interestingly, both institutional investors and CTAs are migrating more towards the common language of stress tests, value at risk, conditional value at risk, and drawdown as measures of risk of the institutional investor in a CTA. We hope you have found this useful. We look forward to seeing you at another one of our videos soon.